Accounting standards play a crucial role in how financial information is reported and understood globally. Two predominant frameworks govern these standards: the International Financial Reporting Standards, IFRS, and the Generally Accepted Accounting Principles, GAAP. Although both aim to ensure transparency and consistency in financial reporting, they differ significantly in various aspects. One primary difference lies in their foundational principles. IFRS is principle-based, which provides broader guidelines and requires interpretation, allowing for more flexibility. In contrast, GAAP is rule-based, with specific rules and criteria for various accounting scenarios, leading to less flexibility but more consistency. Another critical distinction is in inventory accounting. While IFRS permits only the use of the first in, first out, FIFO, and weighted average cost methods, GAAP also allows the last in, first out, LIFO, method. This can result in different inventory valuations and cost of goods sold, affecting a company's financial statements. Revenue recognition is another area where these frameworks diverge. IFRS adopts a single, principle-based five-step model to determine when revenue should be recognized, applicable across various industries. GAAP, however, has more detailed and industry-specific guidance, which can lead to different revenue recognition timing. When it comes to the treatment of intangible assets, IFRS tends to be more flexible, permitting revaluation and capitalization of development costs if certain criteria are met. GAAP, however, is more restrictive, generally expensing research and development costs as incurred. Financial statement presentation also features differences. IFRS does not prescribe a specific format for the income statement, offering companies discretion in how they present their financial performance. GAAP, on the other hand, has established multiple formats like single-step and multiple-step income statements, providing a more uniform presentation. In lease accounting, IFRS and GAAP have distinct approaches. IFRS records all leases on the balance sheet, differentiating between finance and operating leases for expense recognition. GAAP previously only capitalized finance leases but has moved towards a similar approach with ASC 842, though still retains differences in the expense recognition model. Additionally, consolidation methods vary. IFRS generally uses a control model for consolidation, while GAAP uses a risk and reward model. This can lead to differences in what entities are consolidated. The treatment of financial instruments also differs. IFRS often values financial instruments at fair value, which can introduce volatility in financial performance. GAAP, alternatively, has more intricate rules for classification and measurement, aiming at minimizing volatility. The International Financial Reporting Standards, IFRS, have revolutionized the landscape of global finance by fostering greater transparency, consistency, and comparability in financial reporting across different nations. These standards are set by the International Accounting Standards Board, IASB, and are now adopted by over 140 countries, making them a crucial element in the financial reporting framework globally. The core objective of IFRS is to provide a common accounting language so that businesses and their financial statements can be consistent and comparable across international boundaries. This uniformity aids investors, regulators, and other stakeholders in making informed decisions, thereby enhancing global financial stability and reducing the cost of capital for companies. One notable impact of IFRS on global finance is the increased transparency it brings to financial statements. By requiring detailed disclosures and standardizing the presentation of financial information, IFRS ensures that stakeholders have access to more comprehensive and comparable data. This, in turn, leads to greater investor confidence and facilitates cross-border investments. Another significant benefit is the promotion of consistency. Unlike national-level accounting standards, which can vary widely, IFRS provides a uniform set of guidelines that apply to all adopting countries. This consistency not only simplifies the consolidation of financial statements for multinational corporations but also minimizes the discrepancies that can arise from using different accounting principles. IFRS also enhances comparability, allowing investors to analyze financial statements from companies operating in different sectors and regions with the same benchmarks. This level of comparability is particularly beneficial during mergers, acquisitions, and joint ventures, where accurate financial assessments are crucial. Despite these advantages, the adoption of IFRS is not without challenges. Transitioning from local accounting standards to IFRS can be complex and costly for companies, involving substantial adjustments in accounting systems, processes, and training. Additionally, the principles-based nature of IFRS, which relies on interpretations, may sometimes lead to inconsistent applications and require ongoing guidance from the IASB. In conclusion, the impact of IFRS on global finance has been profound, fostering a more transparent, consistent, and comparable financial reporting environment.